And thank you for joining us today for the next AgriFin webinar. I'd like to welcome you to our webinar today on financing agricultural equipment, lessons from Mahindra Finance in India. We have the pleasure of welcoming Mr. Ramesh Iyer, Managing Director of Mahindra and Mahindra Finance, the largest tractor maker in the world by volume. Today, Mr. Ramesh will share lessons from Mahindra's experience in financing agricultural equipment in India. Before I get started, I'd just like to give you a bit of background on our speaker today. Ramesh is the Managing Director of Mahindra Financial Services with over 36,500 crore rupees in assets, and that's about $5.9 billion under management. Mahindra has an extensive branch network spread across the entire country of roughly 1,108 branches. Over the past 2 decades, the company has worked extensively in rural India, extending credit for farm equipment, implements, commercial vehicles, and other automobiles. The company has cumulatively extended credit to 4 million customers and has subsidiaries for rural housing, insurance, asset management, and other international operations. Specifically today, Ramesh will speak to us about the Mahindra Financial Services and their portfolio. He will go into some detail about the financing process, talk about the client segment, walk us through the promotion and origination to approval and monitoring. He will also discuss ways in which Mahindra manages their risk and talk about the profitability and growth and profitability of Mahindra's operations to date. I think you'll find this a very interesting webinar. I've learned a lot from reviewing the presentation, so I look forward to hearing from Ramesh shortly. But before we get started, I'd just like to let you know, as in other webinars, we will not be taking questions during the presentation. Ramesh will speak for about 30 minutes continuously, but I do invite you to write your questions during the presentation in the chat box, which is located in the lower right-hand corner of the screen. Please send your questions to all attendees so that we can see those questions. And then myself and my support team here will collect those questions and facilitate a Q&A session at the end of Ramesh's presentation. The webinar will end promptly at 9 a.m. in 1 hour's time. So I'd just like to get started and welcome you, Ramesh, to start your presentation. Thank you.
Thank you so much, and good morning, good afternoon, and good evening to participants from different parts of the world. The topic that's been given to me to speak on is our experience in extending credit to farm equipment in India. It's extremely important to, at the outset, understand that in India, we have the farmers spread across the country into different states and into deeper rural geography. And they come from different backgrounds, different profile, different segment, and different capabilities. And the farm equipment that we are financing are not necessarily used only for farm application. They also get used for multiple non-farm application. And it's extremely important for the credit provider to appreciate the cash flows of these customers in designing product and services to these customers. Also, it's important to understand that most of the income flow for these customers come in cash, and therefore the credit provider has to recognize this fundamental challenge of ability to handle cash that the customer will choose also to repay in, which means the support of repayment through banking system or through electronic transfers are not necessarily the practice through which repayment happens. It is also important that when we design the product and service, we factor in the seasonality impact and the cash flow cycles of these customers and suitably design product. And finally, these customers do not necessarily have enough of financial statements to prove their credit worth, and therefore an interactive lending process is absolutely essential. So I thought it will be useful to set the tone on the structure of this business model so that when we go slide by slide, you're able to appreciate and connect it to why certain practices must be already enforced. So to start with, on slide number 2, we talked about the customer profile there. We have 3 sets of profile that we have tried to bucket them in. One is a very high-end farmer who have very large land holding. Not necessarily the land is owned by one farmer, but could be by a family, but they have very large land holding. 2, the median-end farmers who have marginal land holding, not necessarily large enough, but substantially larger than the low-end farmers who have a very small parcel of land. Now, the purpose of bucketing them into high-end, medium-end, and low-end is to also give a feel of from where all could these customers normally get their credit from. An high-end farmer, being of a large size, will definitely have capability to be able to even go to the banking segment. So if you go to slide number 3, you would see the profile has been further elaborated into how they are categorized into different segments. So if you look at the land holding, on the high-end farmer has upward of 10-acre land. The medium has anything between 2 and 10, and the smaller has much lower. Now it's very important to understand the second element of it, which is the haulage application. If you look at for a high-end farmer, he does not really put his farm equipment to haulage application, and therefore he does not earn cash flows coming from haulage. But if you go to the medium end, upward of 30% of the money for repayment also comes from haulage, and the low-end farmer puts his equipment to definite haulage use because his land holding being very small has a very limited use, and the haulage is the major use. Similarly, if you look at the user, the high end definitely is very used to this equipment. 30% of the medium are first time user, so they just come into, otherwise they were hiring the equipment for their purpose. Now they wish to own this equipment. And the low end are 100% of them first time buyers. As I said at the beginning, look at the banking habits. Very high when it comes to the first segment, gets down a little, and virtually close to nothing for the low end. The source of loan, again, from where do they resource their money for equipment buying? If you look at the high end, they have their own affordability capability and therefore may not look for financing option. But if you go to the medium end customers, they do look for support at least 30% from other sources, and the low end farmers who use their equipment for haulage application look for full support from the financing agencies. So in a way, through this chart, we are zeroing down to the profile of customer that we work with in different parts of the country. Go to the next slide. Continuity of the same. The banking habits we just finished. You look at the repayment periodicity. All 3 segments choose to repay on a half-yearly basis. which is what I said earlier, designing of the product need to necessarily factor in the seasonality, and therefore, if India has two crop systems, so they will be able to repay only once in 6 months. The other collaterals that they own, the house, the word pakka is a Hindi word, which means it's a permanent house. And if you go to the low-end farmer, it's not a well fully constructed house. So he definitely belongs to the bottom out of the pyramid segment. Similarly, the mode of payment, there are some short forms used. The PDC here stands for the post-dated checks. The high-end farmer has banking habits, and he gives you an instrument in advance with a post date on that, and you need to deposit the check on the respective due dates, where therefore the cost of operation is low. Look at the medium. 30% of them choose to pay cash, since they earn their income also in cash. But you look at the low end, 100% of repayment is in cash, because all their income flow also comes in cash. Very important element, track record. Since they don't have a financial statement for credit decision, one has to look at their track record when one decides to take a credit decision. In the first two categories, the track record is invariably very good. But in the third category, while intentionally it could be good, circumstantially they are not able to meet their commitment, and therefore the decision to price the customer on the basis of this risk factor becomes extremely important. The next slide talks of the segment where we operate. So we have three major segments. One is the pure farming segment. Second is where the equipments are used both for farming as well as let out on hire to other farmers in different areas. And the third segment is a contracting segment where this equipment is used for material carrying or haulage application. If you look at preferences from a finance preference point of view, the farming community prefers to borrow from a banking system. The farming and hiring community is willing to look at bank, as well as in India we have something called non-bank finance company like us, who are listed with the central bank but do not have capability to issue checks or capability to participate in check clearing. But some of us also have retail deposit license from the banking system, and we are categorized under the non-banking finance company category. And the contracting segment looks borrowing only from the non-banking company, because they are all earn and pay customer, which means this equipment has to earn to repay for the loan, and they do not have already a banking approval, or they don't have a credit capabilities document through which they can go to a banking system. If you look at the requirements of these customers, the first segment is highly negotiating segment. They look at maximum benefit on the rate of borrowing, and they look for as long a period of borrowing as possible. Similarly, the mid segment is willing to pay a little higher price and is willing to take a medium term loan. But the contracting segment is not rate sensitive. What he wants is a high quantum of finance, which means he is investing low equity in the business. So he is completely relying on his ability to earn to repay and not his already credit worthiness. The real challenges that we face in each of this segment, in the first segment is very seasonality challenge. One season of a poor monsoon, the crop failure has an impact on the repayment. In the second segment is the skill set required to appraise such customer to look at different sets of cash flow. And in the third segment, it is the collateral depreciation is much faster, because if it is a farm application product, the life of the product is much longer than the product is put to use for haulage application. On the slide number 6, how do we respond to some of this? Is we largely work in the farming and hiring segment, and we work in the contracting segment. We being a non-bank finance company, We are able to design and deliver product in these two segments clearly. And we have developed all our skill sets of people in being able to appraise such customers, and also have set up a very strong second-hand vehicle handling capability, including tie-ups with various dealers to be able to refurbish and sell the second-hand vehicle in an open market, to be able to manage the high depreciation that the third segment brings in. So Mahindra Finance's capability has been built around the second and the third segment. And that's the segment which has registered growth for us all through the year. So if you look at in slide number 7, we have put down our approach to the credit decision. If you look at how do we analyze a customer, we look at what is his current ability, what is his current cash flow, what is his current surplus, and we give a weightage of 30% to what he has currently. And the future earnings is what we look at as 70% of the credit weightage. So if somebody looks at buying of a farm equipment and is able to convince you that he currently has surplus through which he can repay 30% of the loan, we look at what is his ability to earn in future to be able to pay for the balance 70% and service the loan appropriately, which means we have developed skill sets to plot customer future cash flow out of the application of the product that he is in. If you go to the slide number 8, the parameters that is used for credit appraisals are, we look at what is the application of the product, what is the cost of operation, what is the cash flow that he generates, what is the monthly flow he generates, what are his monthly expenses that he need to offset, and therefore what is the surplus that's left with. We take a multiplying factor of that surplus and offer him a loan against the product that he intends to buy, and the difference between the product price and the offer we make of the loan is provided by him as an upfront margin or an equity. It's extremely important in a market like India, where we rely on future cash flow, we rely on the product's capability to generate cash flow. It is extremely important to take local references and understand the customer's track record. It's equally important to understand here that in India, in the rural market, the credit bureaus don't operate. And therefore, there are no credit history of a customer that can be tracked. So it is necessary to understand the customer's intentions and past track record through his local associates or through your existing customer who must have borrowed from you and who has understanding of these customers. So the local references become absolutely essential for a credit decision. On the next slide is what kind of channel have we developed to be able to service these customers. Is we have developed 4 layers of interaction. One, we operate through our own employees. We have very large local employees whom we recruit from the local market. We built their capabilities and they are put on the local branch levels who operate and take credit decisions locally. And which is the reason we have opened branches across the country, and we have about 1,200 branches covering 85% of India's districts. The third element of Sutradhars are the local opinion makers who have a local knowledge of the customer, their background, and they stand many times as a referrer or even as a guarantor, and we rely on his inputs for these decisions. And lastly, we have a channel which is interacting with our large existing customers, and we lend through our existing customer references and have a channel to self-develop a lot of business at the local level, which is called a direct marketing channel, which does not look for business through dealerships, but generate business directly through existing customer and through their references at the local market. Look at how have we de-risked ourselves over a period of 15 years. A company which started off purely as a captive finance company, financing only the parent products, then moved on to financing other automobiles manufactured by other OEMs, We moved on to financing of pre-owned vehicles and tractors. We also have set up a very large insurance distribution business, which is a good collateral protection as well as income generating business. We also have liability distribution like asset management products, mutual funds, fixed deposit products. We have set up a rural housing to the same segment of customer who live in that market. And it is important to understand that these are house improvement, house development loans and not necessarily very large construction. And we have also now got into heavy commercial vehicle financing. So while we have remained largely within the family of vehicles and tractors, but we have gone much beyond captive and we have gone into other OEMs for development of business, and we have gone into adjacency products like insurance distribution and housing. The geographical de-risking has been done by starting from a very select branch locations in 1995 when we started this company, to move from semi-urban to rural, and over a period of time, as I told you, we cover 85 to 90% of India's districts through our 1200 branches. And we actually have customers in 260,000 villages of the country, as against 600,000 villages that India has. Very clearly, we are not financing customers with fixed cash flows. We are financing customers who come from commercial segments and therefore they need to earn to pay. And when they need to earn to pay, we look at the product capability and the customer's ability to be able to generate income to be able to repay. But the success of the business model is also ensuring the collateral protection and the ability to transact on the pre-owned market when the collateral needs to be taken back. If you look at the different assets that we finance, as we explained in the previous chart, and the different liability products that we offer, we have almost into all the auto-related, tractor-related industry, while we have also added, as I said, the housing and the insurance bit. But very importantly, even on the liability side, fixed deposit, we are one of the few non-banking finance company who have the license to accept retail deposits from the market. The sourcing of business, I explained about the direct marketing little earlier. Most of the business comes from the dealers who are the dealers for the OEMs, and we have built relationships with them, and we source business at the dealer points, and we interact directly with the customer. It's important to know that the entire risk is taken by Mahindra Finance. We meet the customer, we appraise the customer, and we take the credit decision. Dealer only generates sales and refers customers to us, and dealers are not a party to the credit decision, because we fear that in an interactive lending, credit decision, if outsourced to selling agency, the sales will overtake the credit needs. And to de-risk ourselves, we have set up our own team which does the credit analysis. From the control aspect, we have substantially invested in technology, and almost all our branches are connected through our intermediary sourcing regions, and 100% of our business is controlled even from the central office. And the introduction of different levels of technology is from more control aspect and service standard aspect, and not from a decision making aspect. It's a large people organization. We have 17,000 people managing the business across the country, and the interaction with the customer is all done by in-house employees, and we are 17,000 people. We do put in a lot of investment in training people's capability, and we ensure that they remain relevant and they become competent and they are employable at any point of time. The processes continuously are reviewed, and new processes keep getting introduced on the basis of experiences. And between 95 to 2015, the 20 years of journey, has only taught us one thing: is a continuous review of process is an absolute essential for success of this business. And geography, as I explained, we cover 85% of India's district and 260,000 villages through about 1200 branches spread across the country. This is the breakup of our branch. And what we see here is the controlling officer 600, through which we cover the entire 1200 branches, and you will find them, as you see in the map, spread across the country. And as I explained to you, on the employee front, we invest a lot of money in training of employees. We have our own training academies where we train people and teach them the method of execution rather than develop leaders out of our training academy. And we teach them hands-on transaction. We recruit people from the local market, and it is an empowered model where people at the branch level take credit decisions, and technology, as I told you, is used for controlling the business, providing high standards of service at the doorstep of the customer, and credit decisions are on the interactive basis. This is just an example of the product offering. They are all in Indian rupee terms. And if you look at a 500,000 rupee is the price of the tractor, and if you add various implements, etc., the price goes to a different level. The margin money is the upfront equity put in by the customer. The balance is provided to him as a loan for an half-yearly installment of 72,000. If you were to convert it into a dollar term, it is close to about $1,200 half-yearly. This is just some growth trajectory of how we have performed over a year. Instead of really glancing at the slide, I can summarize it for you. From 95 to 2015, as we speak, we have had a 28% CAGR. We manage close to about $5.5–6 billion balance sheet, that is asset under management. It's been a company which is profitable from year one. In 2006, this company was listed in Bombay Stock Exchange, and when listing, it was 2,000 crores of Indian rupee as a market cap. Currently, it's close to $3 billion market cap. It's a 52% shareholding by the parent Mahindra and Mahindra, but the other 48% is spread across between FIIs and other retail investors. And the slide 20 talks of the other parameters of profitability, the margins. It's a very high margin, very healthy business to be in India. And the slide 21 will represent the total number of units that we have financed so far, and in value terms, the value that we have financed through this 710,000 tractors that we have financed so far in this market. Cumulatively, we have about 2 million customers that we have live as of today, and on a cumulative basis that we have worked so far, we have close to about 4 million customers that we have worked with. We finance about 500,000 cars every year, and if you kind of look at the size of the balance sheet, what I said, close to about 36,000 crore plus, which is close to $5 billion, and so we have so far cumulatively done about 4 million customers. That's the strength of this organization. So when we look at the final slide of the customer prosperity, we try and meet his aspiration, the purpose for which he looks something. We try and build capability around providing various products, and we take the risk and we make him prosper. I think the idea behind this, these are all earn and pay customer. Customer has an ability and aspiration. He has an equity margin, but he doesn't have the source of borrowing. And that's what we provide and ensure that we meet his requirements. So that brings me to the end of my presentation, and I'd be too glad to take all questions that come my way. Thank you so much for this time.
Thank you, Ramesh. I want to thank you for a very interesting presentation and the details that you provided us on Mahindra Finance's business growth, tremendous growth over time, and remarkably in the last, I would say, 3 to 4 year period. And I would like to ask you questions about that. Yeah. For everyone, I'm sorry I did not introduce myself. My name is Maria Pagura. I head up the Knowledge and Networks program of AgriFin, and I typically facilitate the webinars, not always, just so you have a name behind the voice. So I apologize for that. We have a lot of questions that have come in. during your presentation, Ramesh, that I will go ahead and start with. First one is, some of our participants were curious to know, is there a leasing model that exists, or this is purely asset finance through loan, but what's the difference between this and a leasing model in India, and have you considered that or type of financing?
Okay, in India, especially in the farming community, the preference of the farmer is to own the asset.
Okay. So
and in leasing, the finance company owns the asset.
Okay.
And unfortunately in India, it's a very tax inefficient to do leasing, because you have something like a lease tax, you have something like a sales tax at the state level. So you have different levels of taxes where leasing becomes uneconomical in terms of the model is concerned. So there used to be leasing 5-7 years back, or maybe 10 years back, and it got discontinued over a period of time because of economic reasons.
Okay.
And there is a rethinking in the government's mind to introduce GST as a common tax, in which case leasing will come back to become a product of necessity of tomorrow.
And GSD, what is that? I'm sorry?
GST, a general sales tax kind of a thing, which will be a commonly applicable tax across the country. So in which case lease tax and state tax and all of that will get rolled into one single component of tax.
Okay. And so that may have implications on the leasing market in India in the future, but for right now, the tax regime is quite a disincentive for that.
That's right.
Okay, thank you for that clarification. You did mention the number of clients you have today. You're currently serving 2 million, is that correct?
Yeah, 1.8 million to be precise.
Okay, 1.8. And roughly, what's the breakdown of that client segment? Like, looking at your business growth in that, this links to what's driving your growth. I see in the last slides where you were talking about your growth trajectory over time. Hold on, I'm just going back to the presentation.
So I can give you the breakup.
Okay, yeah. In from like the last since about mid-March to current day, there seemed to be tremendous growth in your branch network, which would indicate you're responding to a high demand in those areas where the branch network has been expanded. Could you let us know what is driving the growth and what are your key segments that as broken down roughly?
Okay. One is, let me start with the breakdown of the balance sheet, which is about 30% is utility vehicles, which are also used in the farm segment for carrying of output. And you have 18% which are pure tractors. You have about 30% towards the car segment, and you have about 8-10% towards commercial vehicle, and about 7-8% which are pre-owned vehicles. So that's a larger breakup of the balance sheet. Now, when you touched upon the preparedness in terms of number of branch expansion in the last 1 year or so, if most of you know, India went through an election about a year back, and the current government has been voted to power with a very clear absolute majority mandate, and there has been a complete rethinking in the part of the Indian government to really focus on growth story, infrastructure, farm support, mechanization in farming, addressing the power requirements of the country. So I think there is a whole lot of approach that the government is talking of in terms of future growth aspiration and developing India into its next pedestal of growth, if you may call. And we very strongly think that this growth will unfold itself and rural India will have a significant role to play. And some of these branches that we have already opened, I would think is an investment for future, waiting for the future growth story to unfold, and we don't want to miss that emerging opportunity.
Okay, so it's preparation for the future.
It's preparation for the future, as well as as I told you, we have got into car financing, and almost all the OEMs whether it's Toyota, Ford, Hyundai. You talk of any international brand, they are now in India and they are trying to set up their dealership network across the country. And somebody like us who act as a good enabler for financing gets that ready opportunity. So we are looking at both current as well as the future emerging opportunities which will need this kind of expansion.
Okay, great. Thank you. Now, I wanted to ask, we had some questions come in about repossession, asset repossession, what, how easy is it to repossess in that process? Like, what do you do when you repossess the assets? How easy is it to resell those assets? Is there a good resale market in India in that side of the business? Could you speak a bit about that?
Yeah. So one is all our agreements with the customer do provide for a clause which allows us the ability and authority to repossess the asset. But there are some processes that one needs to follow, which is giving a notice to the customer and making him aware of the reasons for you to repossess, etc. And give him a fair chance to come and either settle the loan or at least agree to you how does he propose to do it. Failing which, you can go ahead and repossess the vehicle. And there are some states where you also get support from the local administration where you file in your application for the requirement and you get an order to repossess the product. Now, insofar as the resale price and protection of the principal amount is two elements. One, the basic demand for the product in that market. Two, the continuity of the product in that local market with no change in the model and the service standards provided by the OEMs besides the resale price of the product. Second, it also is based on the loan to asset value. If you have extended 100% loan on an asset, and if the customer has not paid adequate amount as installment, but he has misused the product, the resale price is likely to drop. So in our case, when we said 25% initial margin money or equity by the customer, and when you give a 3 or a 4 year loan, even to get the customer investment of 25%, the customer has to at least repay 12 installments regularly, otherwise he doesn't earn his own money. And at the end of 12 months in a 4-year period, which means virtually he has paid you 40-45%, the asset has the ability to protect the principal outstanding. So in short, the principal is adequately protected. The third is, as a finance company, one should not restrict yourself only to lending and basic recovery. I think you need to complete the entire chain, right from appraisal of the customer to recovery from the customer to handling repossessions and also having a chain created for disposal of the product. And we therefore have tie-up with various service providers, and if necessary, we even refurbish these vehicles and offer them either through e-auctions or offer them through a physical auction, or we offer them to some of our existing customers who may want to acquire. And we also provide them with a pre-owned vehicle financing, which makes it easier for customer to buy.
Okay. So
if you look at the end-to-end chain is what works.
Okay. That's very interesting. So if I understood correctly, you try to refurbish the asset, resell it, offer to new clients, or sell it off through the auction processes. But what we're not understanding is to date, what's the rate of repossession? How many instances have you? Is it very small? Can you give us a percentage of your overall portfolio in instances or cases where you had to repossess?
Yeah. So typically, if you look at, as I said, we have 1.8 million live customers, and we don't need to repossess in more than about 1,500 cases a month, and of which about 50% is self-surrendered by the customer. Okay. You don't even have to repossess. You go negotiate with the customer. If he's unable to service his loan, he surrenders the asset.
Okay.
I think fundamentally it's very important to understand that when you're in a credit business, repossession should be your last method of recovery and not the first method of recovery.
Yeah. Yes. Yes, it's very costly is what you're saying.
One is it's costly, and who will want to use your services if you're seen as a company who's financing vehicle and because somebody doesn't repay a couple of installments, you will go and repossess. I think you will have to build that relationship with the customer to understand his circumstances and take corrective actions rather than just take a final action of repossession.
Very, very interesting point.
It's a partnership approach business because we are on an interactive lending and not on credit scorecard method. That's a fundamental difference for everyone to understand. If you are on a credit scorecard method, then you are understanding to lend to a capable customer on the past capability, and therefore repossession could become an answer. But when you are on an interactive lending, you are taking your risk on the future ability to earn. Then you have to partner the customer and not enforce repossession.
So I have a follow-on question, which is linked to this discussion. And you touched upon this distinction of your business model being more of an interactive partnership model with the client. I have one of our listeners is very curious about the types of clients. But at the same time, you are calling and gathering massive data on your clients and monitoring that to deal with the absence of the credit bureaus in your country. This listener is curious to know, do you have a feel of what types of clients are more likely to default in what type of operators you would more or less exclude or not go after in your sales promotion of your services? And do you have a credit, quasi-credit scoring system? Or you may have answered that question earlier, but
I can answer again. If you look at from the data that we have, over a period of time, we have developed our own credit score model. So one fundamental base is the loan to asset value. So higher the loan, the chances of default increases. 2, longer the period of loan, the chances of default increases because of the reason that he repays a very small installment, and when he loses interest in terms of his own ability to earn, the collateral doesn't protect the principal and he wants to surrender, or he defaults, or he misuses the product. I think the third is more internal reason, like you have not done an appropriate credit appraisal and you have relied on a dealer input and you have lent without interaction, which is more an internal reason. The fourth is when a model discontinuity happens. You have financed on certain products and the OEM has discontinued the product, and because of it the resale price of the product falls, and therefore the intention of the customer changes. Okay, so when we say interactive, these are the factors that one needs to capture. And now the last thing is differentiating between circumstantial and intentional, which is in a market you are able to see that most of the customers earn and pay, but some customers choose to not repay even when he. Then you repossess the vehicle and don't even wait for him to become a chronic defaulter. But simultaneously in the other market, supposing the crop has failed due to poor monsoon, and therefore the customer is not having enough cash flow, there is no point in going and repossessing in that market because your resale is going to be the worst.
Yes.
So it is extremely important. It is not about just the decision of whether to repossess or not. It is also a decision of when to repossess. It is also a decision on having repossessed when to sell, and a final decision on if you want to sell at what best price to sell.
It's very interesting. Your model seems, for such a large business, seems very flexible and indeed interactive to the client and meeting the needs. So I see the linkages very clearly for the branding of that client trust, ensuring client trust, and working with the client when the client is he or herself is also willing to work with you in a transparent fashion.
That's right.
I had questions come in about the small farmer segment. You have a lot of first-time buyers, it looks from your presentation, and maybe this is a clarification, first time to be banking or in financial services. That seems like a very risky segment to engage in. And do you do any what are the financial education requirements of working with that client segment? And is the repayment, you did mention that the repayment rate was lower in that segment. I just wanted to see to what magnitude that was a problem and how you're dealing with that.
So one is, let's start from the pricing. So if you recognize the risk, then you price the risk to the customer. So they are always at a little higher rates.
Okay.
And therefore you price the risk already. So that's from the risk perspective. But when we call them as the first-time buyer, right, they are customers who have initial margin money to be put in, but they don't own a vehicle already. So either they were using a hired vehicle or they were not using any. So therefore, they are the first-time buyer. When we say the first-time banking, this is the first time that they are borrowing, right? Because they have never owned an equipment, the need for borrowing did not arise for them. But they would have borrowed for other purposes, maybe some personal loans, or they would have borrowed for some other requirement like housing, etc. But they may not have borrowed for an equipment purchase. So therefore, they are the first time borrower from an equipment perspective. Right?
And do you spend any time with them? Is there any financial education requirements in terms of, repayment, how the loan is, the application?
So typically in rural India, what happens is when somebody comes for a first time buying or a first time borrowing, they almost always come with an existing reference of a customer who is an experienced borrower or who is a local opinion maker. And invariably, in most of the cases, the opinion maker could be a local OEM dealer or an insurance agent who is also a financial advisor. And in all our cases where we have a first-time borrower, we always have a guarantor for this customer, and the guarantor is invariably our existing customer.
And is that guarantor, responsible for repayment, or is it just a moral guarantee that they're vouching for the character of this person?
From a legal agreement point of view, he's a financial guarantor. But from a practical, pragmatic approach point of view, he's a moral guarantor who helps you to recover money from the customer, or at least for sure he helps you in getting back your asset from the customer.
Okay, great. So I was curious about the repayment being biannual, especially for this segment of small farmers who you indicated that they are using their assets primarily for haulage, which would indicate that their cash flows are more regular. What was the business rationale for still keeping the repayment at biannual installments instead of more regular installments to go in line with the regular cash flows that they may be generating from their businesses?
Yeah. Now, the application of the product suggests that their month installments should be more regular. But unfortunately, they are not main contractors. They are subcontractors or even one level below that. So therefore, they let out their asset on hire to the main contractor who pays them only quarterly or half yearly.
Okay.
And that's the reason that they need that extra time.
Okay, great. Then the questions on your sales and profitability. You've shown a lot of growth in the last five years. What explains that growth, and what is really driving it? Is it the farming equipment and implements, or is it more the automobiles segment, or quite likely the construction equipment segment, which we understand that construction is booming in rural and urban areas in India?
I think it's a mix of 2-3 things. One is India rural story unfolded growth last 5 years. And therefore we got the benefit of volume. That's one. Second is the government programs were more towards support to the rural population through various government initiatives, and therefore there was a lot of new segment of customer who came into the equipment buying programs, and that helped us maintain growth. The third is multi-product OEMs, as I told you, reach rural market for their own growth aspiration, and we as an enabler got the benefit of multi-product opportunity. The fourth is we got into pre-owned vehicle and tractor financing in the last 5 years, where we started financing our existing customer selling his vehicle to somebody else. So we participated in financing of that transaction. So I think it's a mix of all. And of course, our own expansion program of going more deeper into the market and expanding the market for OEMs helped us grow this business.
Mm-hmm. That is, when you say OEM, that just for clarification of our audience, OEM is the overseas manufacturing?
Sorry? No, original equipment manufacturer. That means car manufacturer, tractor manufacturer, the manufacturing company.
Yeah, of equipment. Okay. In the government, can you explain some of the government programs? I'm sure our listening audience would be curious to know what in India, what is the government offering that would impact your sales, and how you're partnering with the government in this market.
Okay, so one is, as a clarification, we don't partner with the government because these are programs run by the government agencies or nationalized banks directly to the customer. But one of the most successful program was, if you have heard of the NREGA program, which is the customer getting support from the government as a labor subsidy for local employment. Okay, it was Rural Employment Guarantee Program. So the people in rural India were offered employment opportunity locally, being deployed as labor in contracting or infrastructure segment, and that was a new stream of cash flow that they got in, and that helped them invest in equipment. The other government program, which has been there for quite some time, is the support price on crop. So there is a minimum support price that the government provides on the farm output, and that helps farmers really maintain a healthy cash flow. Now, this is a double-edged sword, which is whenever such programs get withdrawn, then it has severe negative impact on the customer cash flows. And most of the time it does happen that when it is an election year or where the government requires to provide these programs to win the vote banks of farmers, etc., then the support price goes up and they attract a lot of farmers towards them. And after the election, sometimes these programs do get withdrawn, which is what currently we are going through, that the support price is not as high as it used to be for the last 4 or 5 years, and that has brought in some cash flow impact on customers, and that's one of the reasons why you see some degrowth story in India.
Yeah. And how do you prepare for that? Have you had some significant impact on your profitability and your financial performance? How do you prepare for those inevitable impacts and decisions that are coming from shall I say, external forces?
See, there are two sides to it, right? One, your existing portfolio, how do they behave when such programs get changed? And second is what do you do with your new lending? So new lending is much easier to handle because even the overall sales come down, so your volumes also keep coming down. So you don't stretch yourself to taking higher risk. But on what you have already lent, right, you need to improve your recovery mechanism. You may not recover your full installment every time that you go in, which is why I keep calling this model as a physical interactive model, where you prepare yourself to locally understand the changes. And you need to partner the customer, and in the next round of his earnings, he will start paying. What you need to ensure when you are locally there, that the assets are not misused and the collateral depreciation is protected. And you partner the customer and recover installment over a period of time, maybe even in the extended period of time.
Okay, Ramesh, thank you very much. We're coming to the end of the discussion now. I just would like to thank you for your time today. You're a very busy person heading up this very large business. So I'd like to thank you for taking time out. From a personal view, and just to summarize, I think the Mahindra finance model is some very interesting features that aren't obvious from the outset, and that's that interaction and that partnership that they have with the client. The other thing that came out in your discussion is the way that you're dealing with the risk and the changes of the operating environment in a very proactive, prepared way of looking at what's coming on the horizon and already setting up offices to capture future markets. So I think that was very interesting. And then I was struck by the investment in your own staff and people. Behind any great business is its people. So I think that I look forward to seeing very continued success of the Mahindra Finance. But I would like to thank you for sharing your expertise and information. It was a real opportunity for all of us today. Before ending the webinar, I'd just like to ask everyone that's listening if you could take a time to give us your feedback of what you thought about today's webinar. This helps us improve the quality and content of future webinars of this series. If you have any remaining questions about this presentation, please do visit our website and send us an email with those questions, and we'll be sure to facilitate and clarify that with Ramesh and his team. On behalf of the entire Agrifin team, again, I'd like to thank you, Ramesh, and your team for contributing to the exchange of information on asset financing. This is a very hot topic and one we hope to penetrate more and provide more resources to our growing network. We have over 4,000 people on our listserv and over 500 people that have self-selected into a membership that want to engage in a more intense fashion on these issues. So thank you for adding to the knowledge in this space.
Can I take 1 minute?
Sure.
Can I also take 1 minute to,
yes.
I wanted to sincerely thank everyone who participated, and I do hope that I have been of some use in sharing the knowledge of what we do, how we do, and I believe this would be relevant in some market. But I also want to leave a thought in everybody's mind, which is offering an invitation to anyone who wants to visit India and want to visit us and to want to understand more about India rural, India equipment financing, India farm financing. We'll be too glad to receive them and share with them all that we know of this. We'll take them, if necessary, to our branches, to our customers, and get them to know more about it. And it'll be only extremely happy situation for us to receive anyone who wants to visit India and know more about it. And I do sincerely hope that it was a good input session for everyone, but we are available on our emails and all connect numbers which are with you. You can share it with them in terms of our email details, etc. And even after we hang up, if there are questions somebody wants to post, want to get an answer to, we can always do. And finally, I also want to kind of let you know that my colleague Rajnish Agarwal, who heads the business, was also a participant of this program, so that I will also put his email ID, and if he will also be too glad to answer some of the questions that may come our way. So thank you once again, everyone, for participating, and hope it was of some use to everyone.
Thank you, Ramesh. Thank you so much for that invitation, and we will definitely follow up with you on that. If there's that's right down our alley. If there's something that Agrifin can do to help facilitate an organization of people that would like to come and visit, we would be more than happy to do that. So we'll follow up on that. That's a fantastic idea. I think there would be a great benefit to such a study tour. So thank you to you and your team, and we'll be sure to communicate your business contacts in the follow-up emails to this webinar.
Sure.
Okay.
Thank you.
Thank you again, and everyone would just like to say have a nice day, afternoon, or evening from wherever you're listening. Have a good day.
Thank you so much. Thank everyone who helped this happen.
Okay, great. Thank you.
Thank you. Thanks.